For the first time in over a century, the United States no longer holds its historically top-tier credit rating. Is the global economic balance of power now shifting into China's hands? On May 16, 2025, Moody's officially downgraded the credit rating of the United States from AAA to A1. This marks the first time since 1919 that the U.S. no longer holds the highest rating from all three major agencies, Moody's, S&P, and Fitch. The primary reason? A rapid rise in national debt, projected to reach 134% of GDP by 2035, if no significant corrective measures are taken. At the same time, 30-year U.S. Treasury bond yields have surpassed 5%, the highest level since October 2023, reflecting declining confidence in America's ability to manage its debt. For ordinary Americans, this downgrade is not just a Wall Street issue. It means higher interest rates on mortgages, auto loans, and credit cards. For retirees and those on fixed incomes, everyday expenses may become more burdensome as borrowing grows more expensive without any rise in income. At the same time, China, once the largest foreign holder of U.S. Treasury bonds, has reduced its holdings to $765 billion, the lowest level in years. Notably, China has now fallen behind the United Kingdom in total U.S. debt holdings, signaling a strategic shift in financial policy. This sell-off reflects diminishing confidence in the U.S. government's fiscal control and long-term economic stability. If this trend spreads to other countries, such as India, Brazil, or major European investment funds, the U.S. could face an uncontrolled rise in interest rates. For consumers, three question marks. That means higher borrowing costs across the board, from homes and vehicles to everyday credit, placing even more strain on household budgets and long-term savings. The Trump administration is currently advancing large-scale tax cut packages projected to add between $3 trillion and $5 trillion to the national debt over the next decade. Meanwhile, revenues from trade tariffs and customs policies have fallen short of expectations, leading to a widening budget deficit. With rising expenditures and insufficient revenue, the U.S. faces a difficult dilemma: borrow more to cover obligations while facing higher interest rates. If this pattern continues, the federal government may be forced to make cuts in sensitive areas such as healthcare, Social Security, and education support. For older citizens, these changes could weaken access to public services, disrupt Medicare benefits, and erode essential post-retirement support systems. The loss of top-tier credit status affects not only the federal government, but also has far-reaching implications for businesses and the broader economy. Higher borrowing costs mean rising investment expenses for companies, especially small and medium-sized enterprises that depend heavily on bank financing. Some may be forced to scale back production, reduce hiring, or pause expansion plans, impacting the labor market directly. Consumers will feel the effects too, through rising product prices, as companies try to offset increased financial burdens. This comes at a difficult time, with inflation still elevated and household purchasing power under pressure. Internationally, more countries, especially central banks, are shifting reserves toward gold and the euro, moving away from U.S. treasuries. This signals the emergence of a new global financial order, where the United States may no longer hold its central role as it once did. Beijing has skillfully navigated trade rules to keep its exports flowing. Meanwhile, food prices in the U.S. climb higher by the day. Retirees are cutting back on meals, students go hungry, and familiar stores shut down for good. It may be time to ask, who is truly losing this trade war? After the Trump administration imposed tariffs of up to 145% on Chinese goods, Beijing responded with a strategic move, routing shipments through intermediary countries like Malaysia to take advantage of the U.S. customs rule on substantial transformation. Under this rule, goods that are repackaged and relabeled in Malaysia can enter the U.S. at lower tariff rates or even tariff-free. This practice has led countries like South Korea, Vietnam, and Thailand to tighten controls to avoid being used as transshipment hubs, China's strategy has helped it maintain exports to the U.S. while minimizing negative impacts on its domestic economy and employment. But for the intermediary nations, it raises new challenges, preventing trade fraud and safeguarding national credibility. According to the U.S. Bureau of Labor Statistics, the Food at Home Index rose by 2.4% over the past 12 months, while restaurant food prices increased by 3.8%. Notably, EGG prices surged by 60.4% due to the impact of avian influenza, and beef prices climbed by 1.2% in March 2025. Key contributing factors: disease outbreaks, extreme weather, rising production costs, and new tariff policies, disrupting supply chains and further driving up prices. American consumers, especially low-income households, are facing mounting living expenses. Many are being forced to cut spending, switch to cheaper food options, or reduce portion sizes. Soaring food prices are hitting the most vulnerable groups across the United States hard. According to the U.S. Bureau of Labor Statistics, the Food at Home Index rose 2.4% in the past year. Food away from home prices jumped 3.8%. EGG prices surged 60.4% due to avian influenza, and beef prices rose 1.2% in March 2025. Retirees, students, and freelance workers are struggling with escalating living costs. Many are being forced to cut spending, switch to lower-cost food, or reduce portion sizes just to get by. Charities and food banks are reporting a growing number of people seeking help, a clear warning sign of the deepening cost of living crisis. In 2024, more than 7,300 supermarkets across the United States closed, marking the highest number in the past 4 years. The collapse of major retail chains like Walgreens, CVS, Rite Aid, Costco, Dollar General, Save Mart, Macy's, Nordstrom, and Best Buy reflects a fundamental shift in the U.S. consumer and commercial landscape. Meanwhile, China continues to strengthen its global position through long-term strategy, alliance building, and regional leadership. In contrast, the United States is facing growing internal strain as traditional trade and consumption models struggle to keep pace with current realities.
Prices are rising, spending is tightening. Millions of Americans are feeling the effects of President Trump's new tariff policy. But behind the numbers, is there something even more troubling? On April 2, 2025, President Donald Trump announced a sweeping 10% tariff on all imported goods, along with higher rates for specific countries. This move pushed the average U.S. tariff rate to approximately 24%, the highest level since 1909. Economists at the Penn-Wharton Budget Model, PWBM, estimate that the tariff policy could result in an 8% reduction in GDP and a 7% drop in wages. A typical household could face a lifetime economic cost of up to $58,000 due to these changes. Additionally, the tariffs are expected to raise prices on essential goods such as fruits, vegetables, seafood, coffee, and wine, impacting everyday spending for millions of Americans. According to Bloomberg, the Trade Policy Uncertainty Index has reached its highest point on record, surpassing the 10-point mark. The increase signals growing concern over the direction of U.S. trade policy. In response, many companies have delayed investment and expansion plans. A study by Goldman Sachs suggests that heightened uncertainty could reduce business investment growth by around 5 percentage points over the next year. Financial markets have also felt the impact. IPO and M&A activity has slowed, with companies like Klarna and StubHub postponing public listing plans amid an unstable economic outlook. As reported by Business Insider, Several CEOs are finding it difficult to make strategic decisions in light of policy unpredictability under the current administration. Goldman Sachs has revised the 12-month recession probability for the United States to 45%, up from 35%, citing the effects of new tariff measures. Equity markets responded swiftly. On April 3rd and 4th, the S&P 500 fell by more than 10%, the steepest two-day drop since the COVID-19 pandemic. The Dow Jones Industrial Average lost over 4,000 points, equivalent to a 9.5% decline in value. Notably, the top 10% of income earners account for nearly 50% of total consumer spending, making shifts in their financial behavior a key concern for broader economic stability. Historically, U.S. government bonds and the dollar have been considered safe haven assets during periods of economic uncertainty. However, both are now experiencing sell-offs, reflecting shifting investor sentiment toward U.S. financial assets. The yield on the 10-year Treasury note has surged from 4.01% to 4.58% within a week, the sharpest rise since 1982. The U.S. dollar index, DXY, which tracks the dollar against a basket of major currencies, has dropped more than 4% in April, marking its largest monthly decline in over a decade. The downturn signals mounting concern over the trajectory of U.S. trade and fiscal policies. According to the U.S. Bureau of Labor Statistics, the Consumer Price Index, CPI, rose 2.4% year-over-year in March 2025, slightly down from 2.8% in February. However, core inflation, which excludes food and energy, remained at 2.8%, suggesting continued price pressures. President Trump has publicly urged Federal Reserve Chair Jerome Powell to cut interest rates, arguing that such a move would support economic growth. Rising inflation could affect household spending, particularly in areas like food and energy. If the Federal Reserve does not lower rates as expected, borrowing costs, such as mortgage and auto loan rates, may remain elevated, putting additional strain on household budgets and investment decisions. Car prices are rising, jobs are gradually disappearing, and Americans are struggling in the midst of a shifting economic landscape. What is happening to the auto industry, once the pride of the United States? Tariffs and protectionist trade policies have driven production costs sharply higher, pushing the price of American-made vehicles to record levels. According to Edmunds, by early 2025, the average price of a new car has surpassed $50,000 USD, while used vehicles are nearing $32,000 USD. With incomes failing to keep pace, many consumers are left with no choice but to hold on to older cars, even as maintenance costs continue to rise. Cox Automotive reports that a standard oil change, once around $50 USD, now exceeds $100 USD. Hourly wage earners and those on fixed incomes are bearing the brunt of this burden, particularly as broader living costs, from groceries to gasoline, rise in tandem with the new wave of tariffs. McKinsey notes that 75% of American consumers have shifted to buying cheaper goods, primarily food, due to tightening household budgets. At the same time, unemployment is spreading. The manufacturing sector is seeing a jobless rate of 5.2%. Construction has shed 34,000 jobs. And agriculture has experienced a 3.8% reduction in its workforce. These losses stem from rising raw material costs, declining export demand, and widespread order cancellations, all of which are forcing families to cut back on spending, weakening purchasing power across the broader economy. As American car prices rise and deliveries slow due to parts shortages, Japanese and Korean automakers are gaining ground, thanks to competitive pricing and more agile supply chains. In 2024, Toyota captured 12.5% of the U.S. market. Hyundai Kia held 10.2%, and Honda accounted for 8.1%. These vehicles are known for their durability and fuel efficiency, qualities especially valued amid the steep increase in fuel prices driven by new import tariffs. Hyundai has announced plans to invest 21 billion USD by 2028 to build electric vehicle and steel manufacturing facilities, expected to create an additional 100,000 jobs and stimulate regional economies. In contrast, many American automakers have been forced to scale back production due to rising costs, leading to widespread layoffs. This has reduced consumer access to domestic models, while further pushing up the price of American-made cars. The shift toward Japanese and Korean vehicles also reflects a broader trend, a trend toward more frugal consumer behavior, with U.S. economic growth projected to slow to 1.4% in 2025, down from 2.2% previously, according to McKinsey. Many Americans are adjusting their spending habits in anticipation of leaner times. The 25% import tariff has driven up car prices by an average of 13.5%, or roughly $6,400 USD per new vehicle. This price spike not only strains consumers, but also directly affects manufacturing and exports. Ford has halted exports of the F-150, Mustang, and Bronco to China in response to retaliatory tariffs of 150%. Stellantis has laid off 900 workers across 5 plants, while Volvo has announced job cuts ranging from 550 to 800 positions. Current trade policies are weakening the U.S. auto industry, leading to declining revenues, job losses, and reduced access to domestic vehicles for American consumers. Without timely adjustments, U.S. market share for American-made cars could fall below 40% within the next 5 years. The inflationary pressure driven by tariffs is also spreading to other sectors. In agriculture, the unemployment rate surged to 12% in March 2025, the highest in years. This reflects the broader, cascading impacts on the overall economy and the daily lives of millions of Americans. Case IH, a $34.5 billion. Agricultural equipment giant withdraws from the U.S. Over 3,000 American workers lose their jobs. Towns reel and farmers face part shortages mid-season. Following Case IH's exit, could this shock mark the beginning of a global restructuring wave pulling out of the United States? In early April 2025, Case IH, the tractor and agricultural machinery brand under CNH Industrial, unexpectedly issued an internal memo announcing the closure of all its manufacturing facilities in the United States. This includes the main assembly plant in Racine, Wisconsin, and the engine production center in Fargo, North Dakota. According to CNH Industrial, the decision is part of a global strategic restructuring, shifting operations to Brazil, Germany, and India to leverage lower labor costs and tariff incentives. Case IH's withdrawal immediately resulted in over 3,200 American workers losing their jobs. The move delivers a significant blow to the $34.5 billion U.S. agricultural machinery industry, already under strain from global competition and rising material costs. Post-pandemic, the National Farmers Union warned Case IH's exit puts 1 in 4 large farms in the Midwest at risk of operational disruption due to a lack of timely replacement parts. Beyond the direct layoffs, thousands of indirect jobs across the supply chain, from forges and transport firms to control software companies, are also at risk of being wiped out. In Racine, Wisconsin, where the Case IH plant had operated since 1969, over 1,800 workers were laid off. The town, once reliant on agricultural equipment manufacturing, now faces widespread economic collapse. According to the local planning department, unemployment in Racine surged from 4.3% to 11.7% within just 2 weeks of Case IH's announcement. Businesses surrounding the industrial zone reported revenue drops of 50–70%. A local bank noted 30 mortgage delinquencies in less than 10 days. In Fargo, public schools were forced to merge 12 classes and lay off 14 teachers as families began relocating. Mike Thompson, 52, an assembly line worker, told Reuters, "My dad worked here, and so did I. Now, I've lost my job, and my daughter can't continue college because she lost her scholarship from the company. The Red Racers youth team, sponsored by Case IH for 15 years, had to disband due to lack of funding. Many families have moved to other states for work creating housing and social service crises in their new communities. Case IH's shutdown has paralyzed the U.S. parts distribution system. Sensors now take up to 6 weeks to arrive. Hydraulic hoses are nearly impossible to source. Farmers in Iowa and Illinois report equipment breakdowns they can't repair. Warranty requests are piling up. Some are resorting to 3D printing parts or switching to John Deere and Kubota machines, which now offer discounts and fast delivery. Dealerships and technicians are also severely affected. Over 400 authorized service centers face potential closure or mergers. Trust in Case IH has crumbled. Many farmers accuse the company of concealing its exit plans since 2023. Used Case IH tractors are now being sold off at 30 to 50% below market value. At agricultural fairs, Case IH's signature red color has all but disappeared, replaced by competitors handing out free merchandise to attract new customers. Vocational schools have stopped teaching. Case IH repair courses and the company's scholarships have vanished. Meanwhile, local agricultural startups are rising with a farmer's first philosophy, offering a glimmer of hope for the industry. Canada is severing vital ties with the United States, from energy and security to politics. What is happening after the statement? Canada is the 51st state. And why are citizens calling for national self-defense? Manitoba Hydro, one of Canada's major energy providers, has terminated 2 electricity export contracts to the United States equivalent to 500 megawatts per day. Following former President Donald Trump's announcement of a 25% tariff on Canadian energy and goods, the redirected power will now serve domestic regions such as Nunavut, Saskatchewan, and Ontario. The Manitoba provincial government stated this move is part of an effort to reclaim energy sovereignty amid ongoing trade dependence on the U.S. However, the decision may leave Manitoba Hydro facing up to CAD $25 billion in debt, prompting the company to propose an 11% electricity rate increase, starting in 2026 to offset revenue. Losses residents in Manitoba and Ontario may face increased financial pressure as electricity prices rise during a time of climbing living costs. The exit from the U.S. energy market also presents long-term questions for Canada regarding energy security and export diversification. Amid rising trade and political tensions between Canada and the United States, former President Trump has repeatedly referred to Canada as the 51st state. This rhetoric has raised concerns about bilateral relations and Canada's national security. Canadian Prime Minister Mark Carney publicly rejected President Trump's remarks, emphasizing the importance of defending Canada's sovereignty and independence. He also called for increased defense spending and reduced reliance on the U.S. in security matters. Both the Liberal and Conservative parties have expressed support for strengthening national defense and diversifying international partnerships. In Canada's Parliament, some members question whether NATO would intervene in the event of a conflict between Canada and the U.S. Under Article 5 of the North Atlantic Treaty, NATO responds only when a member is attacked by an external force. As such, a dispute between 2 NATO members may not prompt intervention, raising concerns about Canada's independent defense capabilities. Many Canadians have expressed anxiety about the future of the country and its relationship with the United States. Citizens are urging the government to strengthen ties with other international partners and invest in national defense to safeguard sovereignty and security. Canadians are increasingly aware of the need to reduce dependence on the United States and strengthen national autonomy. U.S. tariff policies and controversial statements by President Trump have fueled a wave of nationalism and a call for broader international engagement. A survey by Angus Reid found that 91% of Canadians support reducing reliance on the U.S., while 90% oppose the idea of Canada becoming the 51st state. In response, Many citizens have joined Buy Canadian campaigns, boycotted American products, and canceled travel to the U.S. apps like MapleScan. And Buy Canadian have grown in popularity, helping consumers identify local products. On the political front, Canadian parties are advocating for increased defense spending and stronger relations with international partners. However, efforts to diversify markets and reduce U.S. dependence face several challenges, including high defense costs and geographic distance from alternative trade partners. The United States has ignited a new trade war with China, creating a seismic shift that has prompted the European Union and Canada to reassess their positions. A global realignment of trade flows is now underway. The question remains, who will ultimately hold the balance of power? At the beginning of 2025, the Trump administration officially restarted the trade war with China, focusing on key sectors such as electronics, steel, aluminum, chemicals, and high-tech components. On April 6, 2025, the United States announced additional tariffs ranging from 34% to 50% on over 600 categories of goods, with cumulative tariff rates potentially reaching up to 104%, according to Reuters. The objective is to reduce the U.S. trade deficit with China, which stood at USD $383 billion in 2024 U.S. Census Bureau. However, according to the Consumer Technology Association, the prices of laptops and smartphones in the United States rose by 7 to 12% in April 2025 alone. Bloomberg Economics projects that consumer inflation could increase by an additional 0.3 to 0.5 percentage points in the second quarter of 2025. Essential goods such as electronics, construction materials, and automotive components are at risk of significant price rises, potentially raising the overall cost of living. As the United States imposed significant tariffs on China at the beginning of 2025, the European Union and Canada, two close partners, began to question their dependence on the United States. Currently, annual bilateral trade amounts to approximately USD $995 billion between the EU and the United States, including $450 billion USD in US exports and USD $545 billion in EU exports, and about $400 billion USD between Canada and the US Census Bureau, according to surveys conducted by Eurobarometer and the Angus Reid Institute. 55–60% of citizens in the EU and Canada do not support the U.S. trade war. Furthermore, 60% of Canadians support independent pipeline projects aimed at reducing reliance on U.S. energy infrastructure. Across Europe, particularly in Germany, France, and Italy, public sentiment is increasingly skeptical about the stability of the U.S.-EU relationship. These developments could directly impact energy prices, the cost of imported goods, and job opportunities in industries closely tied to U.S. trade, especially as many countries seek to diversify their economic partnerships. Following the imposition of new U.S. tariffs, financial markets recorded a negative reaction. The S&P 500 index declined by 3.2% in April 2025, according to Bloomberg, reflecting investor concerns over trade costs and corporate profitability. Meanwhile, China has begun attracting additional trading partners. According to estimates by the World Trade Organization, WTO, the EU and Canada could redirect approximately 5% of their annual trade toward China. If this trend continues, the United States could lose hundreds of billions of dollars in trade value over the next 5 to 10 years. Canada is also exploring options to expand its energy export infrastructure toward Asia to reduce its dependence on the U.S. market. CBC News. European companies, particularly in the automotive and technology sectors, are increasing their direct investments in China to access the larger market and mitigate risks arising from trade tensions. This shift could result in higher prices for U.S. imports into Canada and the EU, while Chinese products may become more widely available. The United States and China have entered a new phase of confrontation with a wave of record-high tariffs, triggering widespread manufacturing freezes and mass job reductions. What is truly happening, and who is bearing the brunt of the consequences? Since March 2025, The U.S. has raised import tariffs to 145% on a wide range of Chinese goods, including textiles, electronics, and auto parts. In response, China imposed a 125% tariff on U.S. products, escalating trade tensions and disrupting global supply chains. Losing access to the U.S., which made up about 15% of China's exports in 2024, has forced many factories in Guangdong and Zhejiang to cut hours or shut down entirely. Many workers have returned to their hometowns due to job losses. Domestically, production has declined amid weak consumer demand. China's CPI fell 0.1% in March, while the PPI dropped